absolutely true. Cash is one account that you absolutely spend more time on than necessarily the number itself dictates. Do you understand what I'm talking about there? You can look, you can see the number, and you say, well, I don't want to spend a lot of time on cash. But the other thing about cash, and I think you would all understand this, and as we walk through this today, and I'm going to point out things. I'm going to say, oh yeah, here's an audit procedure that we do, and I'm going to point an example of where I had a problem once with it, okay? Listen, if you're going to steal something, if there's going to be fraud, think about it yourself. If you were somebody working at a company, you're going to steal something, you're going to pull a fraudulent transaction, where would it most likely be? It's going to be one of probably 2 or 3 places. I mean, you're not going to steal prepaid expenses, okay? So what are you going to do? What do those people steal? Money, fraud. So where do you see it? Even if it's related to other things, and we're going to talk about this one case that I had tonight. It wasn't a humongous case, but a person could go to jail in it. It was revolved around receivables and cash, but most of the time when you see something fraudulent, if it's not cash, it's going to be inventory. If you think about a balance sheet, where else are you going to do something where you're going to make off with something, okay? Well, receivables, but receivables is, if you don't steal a receivable, Carla, in effect, you can't steal the receivable per se. You're going to steal the cash related to the receivable. Are you going to, when the customer pays, try and siphon the money off? Yeah, but what are you taking? You're taking the cash. The only other thing really, you really ever see fraud, that kind of fraud. We're not talking about accounting fraud. We're talking about stealing fraud, okay? And like I said, I have seen it. If you become accountants, you may see it some point in time. But you think about it, people steal money, okay? That's what we do. So that's why we spend so much time in the cash accounts determining whether or not the controls are in place and the balances are represented over what they're supposed to be. Now, when we talk about cash, we're talking about checking accounts, payroll accounts. We're not going to talk about petty cash. Yeah, it exists. Does everybody know what petty cash is? I don't even know if it exists too much anymore. It used to be something, again, back in the day where we used more green for things. When somebody ran, and I'm sure they do with some companies, they keep a couple $100 on hand, $500 on hand. Somebody's running out to buy lunch for the office. So they give them, $100 to go buy lunch. So there's usually some physical cash. Is cash a big relevant asset? You'll see some of it depending on what kind of company. Yeah. Would cash be relevant? More of a physical cash, green, dollars. Be more of a relevant in a supermarket, of course. You're going to in retail, you're going to see some cash. Wholesale distribution, you're not going to see cash. I mean, in a business like mine, accounting, if you were auditing an accounting firm, 46 years in the business, once I got paid in cash. Once. A client actually walked in with a brown bag with money once. I swear to God he did. Now, if you ask me why, I'm going to tell you why. They were in a business that had some funny businesses, actually, okay? Where people do things sort of behind the scenes. This was involved in a meat company, okay? There's somebody involved in livestock. And I gather sometimes they do things where they sell stuff off, and it's always a cash transaction. So this client walked in one day and handed me a bag of money. I was astonished. Okay? So physical cash is not necessarily a very big asset in a lot of accounts. And then we're going to talk about what's called cash equivalents. Things like money market accounts. I'm sure everybody knows what money market accounts is. These are, where you buy, in effect, into large CDs. You can't buy a large CD, so you buy a money market fund. They usually trade in the dollar. I mean, they trade even if what you pay for it, they don't have appreciation to them. You make the interest that they make, they can just get a better rate than you can. You can cash them in at a moment's notice. Certificates of deposit in the bank, savings certificates, if those actually exist anymore, you probably won't see them ever. So there's things that we call cash equivalents. don't tell you this in the book, but normally in accounting they define a cash equivalent as anything with a due date less than 90 days usually. That's usually where we define it. So what that means is when we do cash in the financial statements, that line, these items are classified up into the cash category. We're going to walk through the same things. There's the same sort of sets of procedures for every account. How do we audit accounts? We always, again, we start with, and this is going to be a little bit redundant, an understanding of the client and their environment to consider inherent risk and fraud risks. So cash obviously has a large inherent risk and a large fraud risk. Let's just make that assumption right up front. I mean, if you're looking for fraud, this is the account you're going to think you're going to see it, okay? This is more than likely where it's going to be. So there's absolutely an inherent risk in cash. Like I said, the balance itself doesn't necessarily mean anything. As they point out in the book, you can audit cash, determine there's $50,000 in the account, there's $50,000 on the ledger, all facts lead to $50,000. That doesn't mean it's the right number. Maybe somebody's been walking off with money all during the year, okay? And I've seen that. So yeah, the balance is perfect. Yeah, $50,000 in the bank. I confirmed it. It checks perfectly. Check mark. It agrees. That didn't mean that you caught the fraud that occurred during it. Internal controls over cash, extremely important. And the things that, again, you're going to see when you look at controls over cash, is you're going to probably be able to relate it to a lot of other accounts. Because when you're paying something with cash, you're always, are you paying an expense? Are you paying a payable? What other accounts are being affected? So again, the audit objectives always become the same. The audit procedures, in general, the general procedures, if you're going to look at it 50,000 feet, always an understanding of what the risks are to the account. Some are going to be worse than others based upon number of accounts, number of companies, and such. You're, of course, going to get an understanding of the internal control over cash. And we'll walk through a few of the things you have to look for there. And you're looking for the material mistake. Now, again, cash is a funny account in terms of that. Because while you as an auditor may think something isn't material from a financial statement standpoint, the client may look at this differently. Let me give you an example. A number of years ago, on my largest account, it was discovered by the bank that one of their employees, and we're going to talk about the lack of internal controls here, stole $800,000. Okay? Company is a $5 billion company. Their purchases account have 4-point-something billion in it. Cash being millions and millions of dollars. $800,000. Our threshold of materiality in this account was far in excess of $800,000. Way over $1 million was the threshold. In other words, you could find an expense entry that was misclassified for $1 million and not necessarily fraud because it was immaterial. But the $800,000, from a material misstatement standpoint, certainly was nothing you would care about. But from a standpoint of $800,000 walking out with an employee, you're going to look at that differently. So you're going to look at things in this account differently in terms of misstatement versus actual problems that you encounter. A little bit different than most accounts, okay? So again, the procedures, and these are the things, some of the things you really need to understand what we're doing with most accounts. We're again going through them and determining and substantiating. We're doing the general steps of substantiating the existence, establishing the completeness. Okay? Have I ever seen this? We're talking about this, establishing the completeness of recorded cash. Have I ever seen accounts not in the books? Yes. Accounts not in the books. Verify the cutoff and accuracy of cash transactions. I can talk about that. I've seen clients play with cutoffs. Not record checks, push cash receipts into the wrong year, one way or the other. You can see the effects that have, and we'll talk about that in terms of things that you can see or that I've seen. Clients has the rights to the recorded cash, or does the bank have some claims on their accounts? Okay. And of course, presentation and disclosure. Restricted funds. Do they have money in the bank but they can't touch it for some reason? Sometimes they have escrowed funds. You've got to know that. So all of these things, while seeming maybe simple to you, when you say, oh, cash, you've seen it, they reconcile a bank account, you got what you got. Nah, I've seen too many games played with some of these things. And I'll bring up some of the examples. So like I said, generally you will see that for a small account balance, the amount of time you're going to spend with this is probably going to be somewhat disproportionate. You're going to, again, relate it to other things, but because of what it is, it's of course got the greatest temptation for misappropriation. It's a high-risk account. You got to make that assumption up front, okay? You make the assumption it's a low-risk account, and that you don't need to spend time at least documenting the controls and walking through looking for certain things and doing all the proper steps. You can lead yourself into a problem. What is management's job? Of course, to provide assurance. It's the same stuff that we're going to talk about in every type of an account on the balance sheet, that all the cash that should have been received was in fact received, recorded accurately, and deposited properly. I'm going to walk through a case tonight of bad internal controls, not recording cash, not recording checks, and you're going to see how a client got the right number on the balance sheet for cash. The audited cash, we're able to prove the cash in the account, but because of lack of internal controls and lack of segregation of duties, cash that was received is not recorded? No. Cash disbursements made, recorded? No. What are the normal guidelines that you need to know for internal control of cash? Do not permit any one employee to handle a transaction from beginning to end. What does that mean? You've got an employee. If they're authorizing purchases, they're making purchase orders, the invoice is coming in, they're authorizing that. They're authorizing payment of the check. They're signing the check. They're getting the bank statement back. They're doing the bank reconciliation. Why not just give them the money up front and sit the middleman and worry about whether they're stealing? You might as well just give them the money. In this particular case that I'm going to talk about, and maybe we'll just talk about it now. Let's just do that. What did we have here? We had a controller. This was the authority of the controller. One man. Controller. He was authorized. He signed checks up to $5,000. Okay? Full charge of the books. Reconcile the bank accounts. Receive the bank statement. Reconcile accounts receivable. Made all journal entries on the books. Now I might be missing some more things. Could the owner have done anything less? Could the owner have done, let me say it this way, could he have done anything more in terms of turning things over, in terms of internal controls? To this guy? I mean, seriously, what didn't he do? Who was going to catch it? Who's going to catch it? So what did he do? He started writing himself checks. It's an interesting case. You want to see how this works? It's interesting how he fraudulently put things through the books. Did an interesting thing. He wrote himself checks. $300,000 in checks. He wrote to himself. Never recorded the checks. Never recorded it. Never recorded it. But the bank recs were. The general ledger tied in. Okay? How could you do that? Anybody want to take a guess how you do something like that? How do you get a bank rec to work? The general ledger ties in, the bank rec works, he writes $300,000 in checks, never records it. And by the way, you say, well, how did he get away with not even recording them? There was a trick. They had everything was electronic checks. I mean, it was all in a computerized system. But just for safekeeping, they kept a book of manual checks. He took them out of the back of the book. He took them out of the back of the book. He ripped off 50 checks. They had them on the side. I don't suppose anybody wants to venture to guess how you can journalize this out. You know what they're going to count? They got rid of $300,000. Write the checks for bank rec works. Here's how you do it. Here's how you do this. Remember I said you don't record the receipts, you don't record the disbursements? Here's how you do this. Pretty cute idea. I got to get cash to balance. And it balanced. But during the year, you make this journal entry. Debit, reserve for bad debts. You don't do it all at once. Bad debts. $300,000, not all at once. Credit, accounts receivable. $300,000. Remember, he makes all the journal entries. He reconciles the books. He does everything. So he writes off $300,000 in accounts receivable. He writes off perfectly good accounts receivable. They're good accounts. Later in the year, of course, he's got to put the reserve for bad debts back on. So he debits bad debt expense, okay, for whatever. And he credits the reserve. So he gets the reserve back up to the number it's got to be, okay? Whatever that is. But here's the deal. When he collects the $300,000 in receivables during the year, remember, he never recorded the checks that he wrote. He never records the receivables he collects. So the entry he doesn't make is debit cash, credit AR. He doesn't make this entry for $300 when he collects this money. Because he's got to make up for the shortfall of the $300,000 he wrote. So what he does, in effect, so when you get all done with this machination, where's the $300,000 that he's hiding, that he stole? Sitting in bad debt expense. He moved into bad debts. Did the bank rec work at the Sure it did. I didn't record $300,000 in checks. I didn't record $300,000 in receipts. I make sure I don't do it anywhere around the audit time. Okay? I don't do it anywhere around the audit time. None of those checks that he wrote were outstanding. So when you get a bank rec, you don't see an outstanding check written there. Okay? So you don't see all of a sudden there's a check written to him, outstanding. They're all gone. It's all sitting here.
I have a question.
Sure.
You were saying that he was cutting checks for himself from the last 50 pages.
Yeah.
Doesn't it show on your bank reconciliation that someone's taking money?
No, it doesn't show on there because, hey, he's doing the banks. Okay? What he does during the period of time is he does it or doesn't do it. He doesn't care because nobody's reviewing him. He waits till we come in and audit time.
Yeah.
By the time we get there in audit, if you look at a bank rec, what do you got? You got bank, right? Minus outstanding checks is book, okay?
Yes.
At this point in time, there's no outstanding checks to him. The bank and the book agree because he's put back all the money he stole. But he doesn't put back out of his pocket. He writes off company receivables, okay, and then collects those receivables and uses the customer's money the substitute for the money he stole and affect the rights of receivables law. The right entry, if he'd done it the right way, he would have credited cash when he stole the money and debited bad debts. So and just done it that way. And Cohen said, I'm going to write myself off as a bad debt. But he hides it that way. So that's why, again, sometimes with internal controls and such, this is many, many, many years ago, before we did a lot of this internal control stuff. So again, what happened is we violated all the guidelines of good internal control. It happened. There was nobody checking this guy. Have I ever seen things like violations of this? Record cash receipts on a timely basis. I walked into an audit one time. Company had grown so fast. Remember we talked about rapid growth is a problem with internal controls? This was a company that was so growth oriented. The first thing we noticed when we walked into the office, believe this or not, were piles of NSF checks that had bounced and one they hadn't done anything yet, they didn't have time, and cash on another day. Piles of cash. They just hadn't had time to deposit. You can't make some of that stuff up. I mean, we got it cleaned up and all. I'll tell you this is a fact. What do you think you learn more from, a clean audit or a dirty one? You're darn right you do. And that's why I feel fortunate. I grew up, it sounds stupid, I grew up around a lot of dirty audits. I mean, I remember a client I worked on, we made 200 adjustments. 200 adjustments in books. 200 journal entries. I had to recreate account. The books and records were so bad, the only way they could get a correct accounts payable balance was to start the year over again and repost the invoices in the cash. We couldn't figure out if they what. But I'll tell you what, you'll learn an awful lot from that. You'll learn a lot more than tick and tie jobs. Again, you see companies, that's why, I mean, again, good controls, and you see more and more of it today. Obviously, as time has gone on and we use more and more technology, you see less and less of things being done by hand. I mean, you still use checks all the time. Most companies do monthly bank reconciliations to make sure that people doing the reconciliations aren't people writing the checks. In the case of that $800,000, what was the problem there? How did that guy get away with it? He was an assistant controller. He was authorized to approve certain transactions. The company's owner signs all the checks in the company. He created a company, his own corporation, with a name very similar to one of their vendors. This is why we do, one of the tests we do on a lot of accounts, you run a vendor list against the checks. You get an authorized vendor list against the checks to find out if they've got the checks to unauthorized people. So instead of the ABC Corp, I'm just making your name, he made up ABC Limited. The owner of the business made a decision that they wanted to sign all the checks. So every day they walk into this person's office, see a pile of checks like this. He was slipping small ones. These are checks for millions of dollars. So he was slipping like $10,000 ones in at a time to the ABC company and to the ABC Corp. Well, you review a pile of documents like this every day. How well do you do it? You're going to miss some stuff? Yeah. $800,000 later, it was caught by the bank. Guy actually stole the money and returned most of it. We're not going to talk a lot about cash. Again, receivables, again, we're going to all the standard, ways of again, splitting up responsibility, making sure you list all the cash receipts every day, maintenance of separate customer accounts, monthly statements to client customers are extremely important. If you've got somebody stealing money on customer accounts, one of the ways you catch them is when a client calls up and says, you said I owe $500, I paid that bill 2 months ago. So again, all these are deterrents to fraud, good internal control. Here's an easy one. Collection activity on past due accounts. Again, this is just leaving it right out there for somebody. Old cash, old things that, hey, this is a past due, who cares about anything? When money comes in, you steal it. So you got to look at lots of stuff that gets old. You got to keep a look at. One of the easiest ways people steal money in a bank account is old outstanding checks. Now, in your day and age, it doesn't happen as often because you pay everything electronically. In the real world, that doesn't happen. And if you go, checks get lost, okay? People forget them, believe it or not. Checks don't get cashed. So you're a wily employee, you're pretty smart, you're doing the bank recs, you know, look at this check for $3,000 or $4,000, it's been outstanding for 8 months. No. How did I write myself a check for that and then just show that one was clear, okay? You know they're not going to cash the check, why not you cash the money? Very easy, write them off, write yourself a check if you can. So again, controls over that type of stuff. As long as the people doing the bank recs don't have their hands on the checkbook, you've got a much better chance of this type of stuff not happening. Again, cash disbursement, segregation of duties. Go back to my guy there. No segregation of duties. No segregation of duties. He did everything. Pre-numbered checks. Boy, is that, as silly as that may sound, I'll tell you what, we wouldn't have had this fraud on that account if they didn't keep this old checkbook just in case they needed a handwritten check that day. That's what he was able to access. If he had to put it through the regular channels, where it would have gone through the systems and electronically generate the checks off the machine, somebody would have seen. But because they decided, yeah, we'll have this manual checkbook, and now you can keep the checkbook, because I trust you. Well, that was a mistake. I was able to do that, write the checks, and no one ever saw it because there was no control over how. Always, when you're paying bills in cash disbursement side, it's having all the documentation with you. Okay? Why? How many times have you seen either fraudulent payments, you make up a vendor? Oh, it's one thing to make up a vendor, now you got, but if you need to make it, but if you need invoices, purchase orders, receiving reports, you got to make up a whole bunch of documents to go along with it. Okay? Doesn't do you any good if you just, don't have the documentation, you can't get the checks. It also prohibits double payments. You see companies do that all the time. What happens when a guy pays a bill twice? Did that happen if you don't have the right documentation? Absolutely. You send a check out, the vendor goes in and get it yet, send another one, you lose track of things. So most companies with good internal controls are going to put together a set of documents and everybody along the chain of command signing off on them. And this is all stuff that you're going to learn through your internal control walkthroughs. You're going to test these. That's what step one is going to be after you've done your audit planning. Is your internal control checks to see whether companies are doing things here. So again, this is all above and beyond just trying to reconcile a bank account. All places, every one of these is ripe for fraud or ripe for some type of misrepresentation. And if there's a weakness, and believe me, you leave a hole in these things, you leave a hole in your system, someone will exploit it. Someone will. Someone will catch it, and you'll be had. In the case of that thing we talked about, remember the big one? The big one? Bank accounts not on the books. That's what it was. Accounts we didn't know that. Accounts the money was running through were on the books. Hard to audit something you don't see. That's when the confirmation process comes in. But even that won't catch it if you put money into a bank that you don't tell the auditor about. That's where management representation letters get you off the hook a little bit. Did you tell us everything? How do you audit an account that's not on the books and is in a bank that you don't even know exists? Hopefully, maybe somehow the other side of a transaction will show up somewhere in your testing, and you'll be able to track back. But it's hard to do when something's not there. Auditing what's in front of you is one thing. Auditing what you don't see is more difficult. Even the mailing of checks. Checks shouldn't go back through your system, back to people who originate the documentation. It's too easy to change them, to do other stuff with them. So normally when you get to the point of everybody's authorized and somebody signs the checks, it's good internal control that person mails the checks out. And of course, monthly bank recs. You go to a client, find out they're delinquent on their bank reconciliations, your nose should go up in the air. That's an audit thing again. Remember, auditing, I told you, there's a lot of, we can teach you all out of the book. It's this. I don't believe that. It's your nose, your ears, your sense of what sounds right, what doesn't sound right, that's going to get you to the right place many of the times. You see a client not doing monthly bank reconciliations, excuses, yes. But again, you get excuses to any of this stuff. Your sense as an auditor, again, is there's a problem. This is where that term skepticism comes in. Okay? When something doesn't sound right, when it doesn't sound like that's the way you should do things, you should have a sense that there's something wrong. On that client, and I'm being honest, one thing that I look back on with that one, with that deal with the $300,000, how we could have caught that. First of all, of the 300, 200 was after the audit. So it was in the subsequent year. So only 100 occurred during our audit year. That $100,000, well, it sounds like a lot of money, was immaterial. Okay? So it wouldn't have jumped out at anybody. The $100,000, you wouldn't see. It was just buried. It wasn't. The one thing in retrospect that was a little alarming was that during the course of the audit, and when I talked to the audit partner, they said, yeah, maybe we should, was that something as simple as a bank reconciliation, which should be something that's readily available and probably you should be able to get day one of your audit. Listen, let's look at the balance sheet. You start at the top. Most of the times when you start auditing, you don't just start in the middle. You'll say, well, let's start down here. Okay, fine, let's start with cash. The bank reconciliation kept getting the bill. I didn't get around to it yet. There's a couple of reconciling items I got to take care of. Here's your receivables. You know what the receivable. Here's your fixed asset account. Here's the schedule of accounts payable. Here's your accrued expenses. Here's your expense analyses and such. And it was like every day, it was like, well, we need the bank recs. Yeah, I'll get to them tomorrow. Yeah, I'll get to them tomorrow. And finally, the audit was due. It was like March 31 requirement of the bank, and it was like March 28th, and it was like, well, we can't get done unless you give us the bank recs. Okay, here, I'll have it tomorrow. You get them, and you don't spend necessarily the time. And what probably, again, should have, when you look back on it, but the client never blamed us for this. The client thinks it was our fault. They took responsibility for giving this guy all that authority. And the funny thing is, I had never, this was a client that normally talked to me, and he had upped, prior to that year, the guy only had authority to sign checks up to $1,000. And without my knowledge, he'd given him authority to sign checks up to $5,000. Normally, in some companies, if you did that, I would say to you that the check should be dual signatures. Okay, fine, you can sign checks, but somebody else has to sign them too. That way, all of a sudden, a lot of companies have that. Checks over a certain balance need 2 signatures. It's a control. They did this without ever talking to us. But the one thing, again, afterwards, when we Monday morning quarterback this, was we should have been, I thought, a little bit more aware of why did the bank rec, why was that always being put on? So that would give us a greater sense that there was something going on. Yeah. So again, Audit of Cash, this is the same. We're going to go through this again, account by account. It's always going to say sort of the same thing. Understanding the client's environment, inherent risks, including fraud related to cash. We talked about that. There's extreme inherent risks. Most of the time, there's fraud risks. Cash is that type of an account. Okay? We're always going to walk through in detail internal control over cash. We've got to know that. This is, again, it says the risks of material misstatement. That's a tricky one, like I said, with cash. Material misstatement in the financial statements is different because, again, fraud doesn't necessarily manifest itself in a material misstatement of financials. $800,000. Does that sound like a lot of money to everybody? Darn right. Was it a material misstatement of the financials? Not even close. Not even close. $800,000 buried in a purchases account of $4 billion? That didn't even register, on the Richter scale there. So sometimes you got to go a little bit above and beyond in terms of the audit of cash. What are you going to do when you're testing controls? You're going to do the usual stuff. You're going to do the walkthroughs. You're going to do sampling cash receipts. You're going to take some cash receipts from a day or several days and walk them through the system to see that they're recorded properly. You're going to do the same thing on the cash disbursement side. You're going to take documents. You're going to take checks. You're going to walk them through the system, making sure the documentation's right, all the documents are put together, the checks were paid properly, they were authorized properly, and that they were recorded properly. All of that is hopefully in the interest of, again, getting a good sense that they've got good internal control. Now, one of the types of procedures that we do in here, okay? So, okay, you've done your internal controls stuff. You're satisfied or you're not satisfied. What are some of the other things that are necessary in terms of substantive audit procedures in doing a cash audit, okay? Well, first of all, you're going to always start with trying to reconcile the cash balances to the general ledger. I mean, they give you a reconciliation, does it tie into the GL? You think it automatically always does. It doesn't. Have you been out on anything that didn't tie in?
Yeah.
Already? Yeah. Some didn't agree?
Yeah. They forgot to add some outside checks.
In other words, they were overstating cash. Carlos just brought up a perfect example that the book will point out. How to play with a bank record. And I'll tell you reasons why, okay? They didn't show some outstanding checks. Well, if you don't show outstanding checks, cash is overstated, okay? But why would people overstate cash?
In this case,
well, sometimes they forget. But we'll put it this way, if they did the bank record properly and recorded the checks properly, it wouldn't agree to the books. Or maybe it didn't in your case. Oftentimes, you're going to see companies want to play with the cash balance. Some of it's perfectly legal, some of it not. I've seen examples of the following. Outstanding checks, as Carlos said. Checks written, not recorded. Checks written, not recorded. Anybody know what a health check is? So a client writes a bunch of checks at the end of the year. I had this instance one year with a client that I don't know happy to say. I couldn't stand this client. This was just one of those accounts from, there's clients you're going to like, there's clients you're not necessarily going to like as much. This was one of the ones you never trusted. Client had written a whole bunch of checks at the end of the year. December 31st year end, writes a whole bunch of checks. We see them in the ledger. All these checks written. Clients ask us, I didn't disperse it. When should you record a check? What'd you say? Who said when you're right? When you're right. Well, anybody disagree with that? Yeah, when you record a check.
For the date of when it's supposed to be cashed.
Well, you don't know when it's going to be cashed. No, when it is cashed. When you mail it. Until you mail a check, you haven't done anything. You wrote a mistake. Now, what a lot of companies do, it's not unusual, is they can write the checks today, but they know they don't have money in the bank yet. So they put them in a drawer, or they put them on the side and say, listen, we're going to mail them in a day or two, okay? So this guy had written a whole slew of checks right at the end of the year. But he added them back in his bank reconciliation so he had the money, because he maintained to us, I didn't mail these checks yet. I didn't mail these checks at year end, okay? I held them because I didn't have the money to cover them. But like I said, there was something about this client that didn't pass our test. So Carl, what do you think we did trying to audit? His statement that he didn't mail the checks at the end of the year. What would you do? Anybody know what they would do to try and audit? Whether that's a true statement of fact or not? I'll tell you what we did. We audited the pay date on the back. Audited the pay date on the back. Stan said, the date they were cashed. So this guy said, on December 31st, I showed us some checks. I didn't mail these. So that's interesting. That's interesting. You wrote them on December 31st, you didn't get it, you didn't mail. Nope. Okay, this company's in California. We showed you. This company's in California. That check was cashed on January 2nd. So that was interesting. On December 31st, you didn't mail the checks. You didn't work on January 1st. I assume you didn't come in on New Year's Day. And mysteriously, this check got from New Jersey to California and got deposited. And I said, you can't drive it there in a day. You couldn't mail it there in a day. And this was way before electronics. We went through all of these checks, and we found check after check after check, and got cashed way too quickly to document, to corroborate what this guy said. He said, you're full. You mailed those checks. Because you mailed those checks, we're recording those checks. This brought his cash balance down to like nothing or almost nothing, which was an issue. Because again, companies do the following. Remember, a balance sheet is a moment in time. And what they talk about in here is something you will see. It's called window dressing. You can maneuver your balance sheet for a very short period of time by doing some things and maybe reversing them a day or two later. Some of it legitimate, some of it not. This one wasn't legitimate. You can't write checks and mail them, okay? What do other companies do? What if I want to show a good cash balance, okay? So I do the following. I keep my books open for a few days after year end. Remember, we have a thing called deposits and transit, right? Check sent in on December 31st. Go get to the bank for January 2nd or 3rd, right? Deposits and transits. But I keep my books open a couple extra days. So the money that comes in on January 2nd, January 3rd, January 4th, right? I want to get it into December. I want to boost my cash balance. I need to boost it. Maybe I need to do it for some type of covenant or loan agreement. So what do? I take my deposit slip, and I'll fool my auditors. Instead of writing January 4th, I'll date it December 31st, okay? I'll record it last year in December, okay? I'll record it in December, and I'll tell my auditors it was a deposit transfer. Make sense? Debit, cash, credit, whatever. I'll call it a deposit and transfer. You as an auditor should have common sense. You go, you know, you check, how do you expect to deposit every day? Oh, I send the guy in the office. He writes down the checks every day. Oh, well, no, I don't have to do that. Really? You do that every day? Absolutely. Good. How come this deposit and transfer of yours cleared on January the 5th? You didn't deposit on January. I see January 2nd, 3rd, and 4th deposit. Or maybe I don't see deposits. There's another one. How do I catch this? Mysteriously, you didn't have a deposit on January 2nd, 3rd, 4th. You didn't record it in your books. Your first deposit next year was January 6th. Okay? And this one didn't hit the bank January 5th. You held those checks from December 31st to the 5th. When you told me under my own control, and I checked during the year, every time you got checks, they went to the bank that day. Mysteriously, on December 31st, those took 4 or 5 days to clear. So again, using your sense. It'd be easy to take and die. You clear the bank 3 or 4 days later. Does anybody know why, and we're probably going to skip over some stuff, but it's a good time to talk about it. Did you notice one of the procedures here? Number 4. Important procedure. Obtain a cut-off bank statement containing transactions of at least 7 business days subsequent to balance sheet date. Requirement. Well, I don't know if it's a requirement, they always did it. You send it to the bank. Company authorizes it. For the 7 to 10 business days subsequent to year end, they're going to do what's called a cut-off bank statement. Most banks do it once a month. You can ask for a statement in the middle of the month. You can ask for a statement at any point in time. Bank can't tell you, you can't have a statement at the end of the month. I want a 7-day statement. However, you're not to mail it to me. You're to mail it directly to my auditors, unopened, at the auditor's address. So I see what went on in the first 7 to 10 days of the year to see if it coincides. Do I all of a sudden find those outstanding? I start seeing checks clearing with numbers. Gee, that was dated December 28th. I don't see it on my outstanding check list. Maybe they didn't want to record those checks for whatever reason. Or those deposits and transfers. So there's a lot to be found in some of these procedures. So that one's an important one, getting a cut-off bank statement. Look at the first 7 to 10 days to see whether or not things were recorded properly. Of course, doing a bank reconciliation, you don't have to do it. The client can do it. You just have a responsibility to look it over and determine whether it's accurate or not. In the old days, we used to go through the outstanding checks and see if they see if there were missing ones like you found. We just talked about cutoff, or receipts in the right year, or disbursements in the right year. Maybe the client doesn't want to include receipts. Maybe again, hey, I don't want some more income this year. I'm just not going to pick up some. I made some big sales at the end of the year. Now, other things are perfectly legitimate in terms of window dressing. There is nothing legally wrong with a client determining at the end of the year, I don't want to show a lot of accounts payable. I'm going to pay down my payables dramatically in the last day of the year. Or I'm going to push my clients pay this year so I get my receivable money. I don't want to show the bank I have that much of receivables. I'm going to try and get more money. Or I'm going to push some sales. I've had some clients actually really push sales in the last week of the year because they want to get their income statement up. There's nothing wrong with that. You can do that. It's when you see transactions like on December 31st, there's a humongous loan on the books to a corporate office. The guy owes the company $1 million. I don't want to have to show the bank $1 million receivable from me. I'll pay it off on December 31st, and on January 2nd, I'll reborrow the money. So I'll just put it back in for 2 days. It doesn't show on the balance sheet. Unfortunately, you have a disclosure requirement, and you'll see subsequent transactions. Is that a legitimate window dressing? No. You had the thing outstanding all year. You got it off the balance sheet for that day. Yeah, it's legitimately paid off, but you'd have to disclose to the reader, hey, the officer company borrowed $1 million, was paid off on December 31st, the officer reborrowed the money on January 2nd. Again, what you're going to do, and I'm not going to walk through all these things, in Audit in Cash, you can go tie in your procedures to the primary audit objectives. Now, one of the big ones that you always do is something called analyze bank transfers. If you understand banking, you understand that when you write a check, now it's less so today with electronics, more so years ago, but you write a check between accounts, okay? The deposit goes in to whatever before the disbursement comes out. You understand that? The deposit goes in before the disbursement comes out. In other words, if I give Carlos money, he takes the check to the bank today and deposits it. It goes into his bank account and he gets credit for it. Until the check comes back against, it can't get charged against my account the same second unless it's an electronic transfer. Now, we do a lot more of it quicker today. But in the olden days, and it's still true when you're doing checking, it may take a while for that check to come back against my bank account. So temporarily, that money shows up in 2 places. Okay, you understand what I'm saying? It hasn't been deducted from my account, but it shows up in his account, okay? If you were playing games on a company, and you had a multitude of bank accounts, and you didn't want to show they had cash, you might play that game, which is called kiting. Moving a check between accounts, showing it here, not recording the disbursement here until next year. Okay? Now you've got too much debits, you've got more cash, you've got to have some credit. And maybe you're trying to inflate your income. So one of the procedures you do on all accounts is if you have multiple bank accounts, whether it be one company or multiple companies, if you have a consolidation, you have 50 companies and they're all writing checks and moving money around, normally at the end of the year, you do what's called a bank transfer schedule. and you take each and every transfer in the last 7 or 10 days of the year, and the first 7, 10 days of the year, and you trace them between sides to make sure that the accounting is consistent, that you don't accidentally have cash in two places. Easy way to show too much cash, interbank transfers, because of the timing issue. Always looking at payments to related parties because of disclosure requirements. We talked about fraud, different types of fraud. Did they record all cash transactions at the first time of the year? Certainly my guy over there did. He didn't record some receipts, he didn't record some disbursements. All cash payments properly authorized and for a legitimate business purpose? No, my other guy who stole $800,000. No, they weren't for a legitimate business purpose and they weren't properly authorized. Oh yeah, they might have properly. He had a right to authorize payment. Unfortunately, he fraudulently authorized it. We had internal controls there. Fraud that may be disclosed. What may you find through your controls? Cash receipts deposited before any record is made. Again, if you give somebody the ability to get their paws on the cash receivable and cash, you just set yourself up. How easy is it to write off an account receivable, make an entry, get rid of a receivable, and steal the cash, okay? You can figure out a way of depositing and checking an account. And sometimes it's not too hard. Payment for things not received. Does that happen? Yeah. Get a friend to set up something, where you make a deal with a vendor. You don't have to, tell you what, we don't check purchase orders. We don't check receiving reports here, okay? All I need to do is I have the authority to sign off on invoices when they're here, and I send them to the boss, and as long as my signature is on the invoice, your bill will get paid. How about this deal? Send me a couple of fake invoices, okay? You don't have to send any material. I'll sign off on it. We'll split the money. Okay? Don't worry about it. Send me a couple. You don't have to send me big ones. Send me a few. We'll slip them in. We'll put them in for office supplies, purchases, nothing ridiculous. But if I don't need the purchase order, I don't need the receiving report. How hard is it to do number 2? How hard is it to do number 2 accidentally? I don't even know it, okay? Duplicate payments. Most of the time what you're supposed to do in the lawyer records, when after you pay a bill, stamp them, cancel them, make sure that you can't pay them over again. Overpayments to employees, or payments to fictitious employees. Payroll. It's not unusual. It is not unusual. How hard would it be again to do a payroll test? Employee and a supervisor are in cahoots. You put in the overtime, all 4 of them will split. Haven't done the internal controls on that stuff, you can get caught in that. Fictitious employees, they'll come in with thousands of people. A foreman says, I have 100 people in my department. Maybe he's got 98. Sets up a fake account, which is really his. Payment of personal expenses. You see this stuff. None of this stuff is made up. These things all happen. Potential misstatements like cash disbursements, inaccurate recording, duplicate payments, unrecorded disbursements. My friend over there. What are the other procedures is required? It's going to be required in several instances. You're going to learn about this as we go through different accounts. If you remember, we talked about the fact that the best verification that you can get is outside verification. It's not inside verification. It's not the document you produce or your client produces. It's a documentation that comes from outside. One of the things we always do is verification through confirmation with financial institutions of bank balances. You can get fraudulent bank statements. Clients have figured out ways to do that. Give you bank statements that are right. So one way of verifying that the amount of money in the bank per the bank is correct, and it's always been a procedure, is you send them what's called a confirmation. Now most of them are standard forms that have been agreed to between the accountants and the Bankers Association. two things normally covered on it are deposits and loan balances. There's two sections in the standard bank offer. There's a picture in the book. What you're asking the bank is, how much cash do we have, and how much money do we owe? Now, the way they describe in the book, and I guess we do this, okay? Figure out how you can do it electronically these days. There's electronic forms. There's even something like an electronic confirmation process. What? Confirmation.com, okay? But in the old world, we sent confirmations. We used to send them blank. No, we didn't put the numbers in. You had the bank come back with them. Now, what you're hoping is, of course, today we put the numbers in. You're hoping the bank's going to sign on the bottom and agree with the numbers. What you catch once in a while is when the bank sends back additional information and says, you told me, you mentioned one loan, you forgot this loan. Ooh, there's a loan I didn't know about. Where there's a bank account I didn't know about. That might have worked in some accounts where maybe they were hiding a bank account. Now, what are reasons for hiding a bank account? Well, they give a good one in the book. What if you're somebody making illegal payments for something? Bribes. Okay? You're making illegal payments for bribes. You're in a business, that's the way you do business. Well, you may not want your auditor to know about it. So you set up a separate account. We'll keep it off the books. We'll figure out a way to fund it. Okay? Figure out a way to fund it. We just don't want the auditors to know about it because we're doing something illegal. Now, if they put it in a bank you don't know about, it's hard to get a confirmation to somebody you're not aware of. Okay? I always send a confirmation to a bank. I don't send them out blindly to every bank in the world. Just say, tell me every account that exists for this client. But it's an important process. It's important if the numbers come back different, then you reconcile them. You make sure that the bank's records and your records agree, or if they don't, what the differences are, whether an adjustment needs to be made, or a timing difference. So it's a very important and essential part of the cash audit process. And again, it's that outside verification which is so important. This is what a standard account, you can't see it here, you can see it in the book. This section will deal with the cash balances, and this section will deal with the loan balances, and it'll give you all the facts about the loan. This is an interesting thing we put in the collateral. Maybe the client told you it's an unsecured loan, forgot to tell you that they secured it with all the inventory, like that little disclosure there that maybe you wouldn't know. Here you got one where furniture and fixtures are unsecured. Or maybe they told you both are unsecured. Just a little disclosure that's necessary and important. So there's a lot of information you can glean from this. Plus, you get a very good piece of audit documentation when you do this. Proof of cash. They show you one in the books. We used to call what's called a block proof. Different way of doing a bank reconciliation, where you start with an opening reconciliation, an ending reconciliation, and in between, you have the receipts and the disbursements, and you reconcile those between the banks and the books. I don't know if we do them. Ross, did you do any of those while you do bank recs? Or did you set up client's bank recs for the most part?
Yeah.
Yeah. Sometimes, yeah.
You have to check it with the bank to make sure that it's all typed in.
Yeah, but sometimes you do these, sometimes when you think there's a problem. You also do many of them. It looks sort of like this. It's called proof of cash. You have an opening bank rec when it started the month, the ending, and then you prove the deposit between your records and the bank, and you prove the charges against between you and the bank. You've tied in all your record keeping between you and the bank. And normally during the year, you would look at a couple of bank recs of the clients. Like again, in the case of this one fraud, maybe we would have caught more if we looked at the bank recs. Maybe they never did them. I don't even know. And to be honest with you, I don't even know if he did bank recs during the year. Something tells me he probably didn't. Because if he had, some of this wouldn't have balanced during the year. This isn't just the electronic way of now. Things go quicker today than they used to. Used to be, one of my clients kept cash in the bank the longest. There were actually, if you really understand the banking system, you understand that when you write a check to somebody, nothing happens in your bank account until it comes back and hits your bank account. But when you send a check to somebody in Montana, that bank in Montana doesn't have they don't transact with your bank here in New Jersey. There's got to be a central clearing. And that's the Federal Reserve System. So when you write a check here, your account never knows about it, goes into somebody's account in Montana, they have a debit, they have a credit to their account, the bank has a liability, and they set up a receivable from the Federal Reserve. They transact with the Federal Reserve, clear that, and then the Federal Reserve clears with your bank and eventually sends it back the other way. So it's a long process to sort of get to, and it's a lot quicker today with electronics than it was used to. There were known banks in this country that cleared checks the slowest. Known banks. And they were in some faraway places and states, and companies used to intentionally set up their bank accounts in those banks. Intentionally. Because they knew that it took the longest to clear a check from that bank. Sometimes it would take another extra week or so. So they had use of the money for one more week. And if you're running a tight cash situation, if you're in a company that has very tight cash, you need as much time as possible. That doesn't happen as much now. That's called time to float. That's the terminology, to float. The difference between what you really have in the bank and what the bank thinks you have. Kiting we talked about before, this is when you've got cash in two places. I'm not going to go into a lot of details about that. What's the purpose? Of course, if I want to inflate cash on my books. We talked about a bank transfer schedule. So we just sort of finished cash. We did all the procedures, we did our internal control, and hopefully we didn't find anything. So about the other side of this, the financial investments. What's tricky? Because the one thing you don't normally have with cash, the one audit objective you don't have an issue with is valuation. The evaluation with receivables, you got to come up with a return for bad debts. The evaluation with inventory, you got returns for obsolescence. The evaluation issues with fixed assets, you have write-downs or impairment. The evaluation issues with financial investments, marking them to market, how to mark them to market, how to value certain ones. But cash is an evaluation issue. I have in the bank what I have in the bank. Cash is cash. About the only place you look, you know any place you might have a valuation question? You know you come up with where you might have a valuation question concerning cash? And it's really not that hard. Who said that? Carlos. There's a reason you're not. Carlos is right, fine. When you've got money, when you've got cash in bank accounts, they're not denominated in dollars. Okay? Where you've got to do a conversion, which isn't that hard, but you do have to make sure that or you have it in some country that's just done a big valuation or something. But yeah, that's about the only time you're going to look at valuation with cash. You're right, cash is cash. It is what it is. A dollar's a dollar. You don't have to look at the value of a dollar. So specialized knowledge to financial investments. Okay? I think any of us can audit cash. Specialized knowledge, I think it's just a matter of a sense of good auditing. Knowing what to look at the company, look at the people, looking at the controls in place, using your sense of, your good audit sense. But when you get to financial investments, you got a lot more to it. There's a lot of complex accounting issues that are involved in investments. You have valuation issues. You got weirdo investments, derivatives, which are difficult to understand, let alone to know how to value. And then, like I said, in the fair value. But you're going to be doing the same sort of procedures to start your day, okay? This is going to sound very similar. Use your understanding of the client, the environment, the inherent risks related to financial instruments. This is one where it's going to be a little different. Some companies are going to have a tremendous amount of this, and some of them are going to be so simple you're not going to really be worried about it too much. You're going to differentiate in this area probably between public and private companies to some extent. Because in public companies we have the audit committee and we have an investment committee, things of that nature. You're going to see that. not-for-profits, things of that nature, so you're going to have different controls. But some companies are going to have very limited financial investments. Some are going to have very simple ones. You know, some companies can bear something as simple as, hey, listen, we always have a lot of cash on hand. We want to make at least a little bit of interest, so we're going to buy money market accounts, okay? Maybe we're only earning 1 or 2%, but 1 or 2% is better than 0%. Or maybe you get companies that occasionally dabble in the stock market. I got a few bucks. We got a lot of cash. I'm going to take some risks. Okay, I buy some, just a few good stocks. Maybe there's some good corporate bonds out there that are paying 3 or 4 or 5% today, and I want to make a little bit of money. So this is one again. You're going to want to get a fraud and risks. I don't believe you have necessarily normally the same fraud risks as you do with standard cash. I haven't seen a lot of stuff involving financial instruments, in financial investments as fraudulent. Now, you might say you read about a case a couple of years ago called Madoff. We all know who Madoff was, I assume, right? No? The guy who perpetrated the largest financial fraud in history? I know you know. What did he steal, 150 billion or something like that?
He's living in a country club in prison right now.
He's 150 years, I think, that he was. What? Some committed suicide, the other one died. One died, one committed suicide. He lived both ends of life. But yeah, certainly he committed fraud around financial investments. Why someone didn't notice or comment, did anybody happen to notice who the accountants were on that deal? There's a reason you wouldn't. Because the accounting firm was smaller than your account. You don't have to. He had a 1 or 2-man accounting firm auditing billions of dollars. Billions of dollars, and nobody raised a flag and said, we need that those guys though. Normally you don't get that deal, okay? You don't want a 2-man shop, you don't want something that size. So yeah, of course there can be frauds in financial investments. What are the things you're looking for that are a little different here than cash? Investment policies. Every company should have an investment policy. For sure you'll see it in public companies. You'll see it on not-for-profits. I've served on the investment committee of several not-for-profits. In fact, I don't even think you can open an account as a not-for-profit without giving the brokerage house your investment policy. I'm pretty sure that's a document that you need. Yeah, I'm 99% sure that we have to give them investment policies before they'll open an account for you. Investment committee of the board of directors. If you've got a company that makes some financial investments, there will be an investment committee made up of financially savvy people. Separation of duties, same thing. People authorizing purchase and sale aren't going to be the same people maintaining the records. It talks about having custody of the securities. This doesn't really happen. What else are we going to do? This is a place we're going to start to tie other accounts. We're going to be auditing several things here at once. You're not only going to be auditing the assets, but you're going to be auditing the income and the revenue that goes along with it, the interest and dividends. You're going to be tying in several accounts at once in the audit here, and you want to make sure that the controls over this are in place. Making sure, is there somebody making sure that we receive all the interest and all the dividends that we're entitled to? Periodic physical inspection of securities, no. And this one's always going to be tricky. We're not going to go into a lot of detail on it. There are so many complex financial instruments today, derivatives, futures, options, and such. One of the things you want to make sure if you're auditing a company is that the company itself has the ability and the personnel capable of accounting for these complex transactions. It's certainly, I would say, in my top 5 list of areas the mistakes are made. Not because people aren't good people, because some of this stuff is extremely complex. So easy to make a mistake, so easy to misinterpret an investment and how to account for it. One of the things you're going to look at is the controls. Do they have the people in place to do the proper accounting for it? So we're walking through the same set of three things here. We get the understanding of the of the inherent risk. We do the internal control. We look at the risk of a material misstatement. Certainly, as Carlos pointed out, valuation, certainly an issue. Could you misstate? Is there a reason to misstate? Absolutely. Absolutely. Look at a guy who's doing hedge funds. Look at Madoff. He had a reason to mistake. Why? Would you have an issue? Would you be worried about overstatement if you're auditing any investment advisor? Of course. Why do they make money? First of all, they make money off of success. Success is assets going up in value. They get paid for percentages of assets they manage. They get paid a percentage of the gains they make. So they have a financial reason for possibly overstating things. One, and two, wouldn't you possibly have a reason to overstate things? If I want to bring in more investors, I bring in investors through performance. I bring in performance through good valuation of my securities. I can push up valuation. I get better performance. I make more money. I attract more investors. What do you think Madoff did besides stealing all their money? He never made the investors. How did he attract all those people? You go back. How did he attract them? Through continually showing returns that were better than industry averages. There were people out there. I know a person who told me he was on an investment advisory committee for a not-for-profit that invested in Madoff. He's a very astute businessman. He said, I never once believed the returns this guy was paying in that marketplace. Nobody's that smart. He said, I went to that committee when they said they wanted to invest with this guy. I didn't believe it. And there were a lot of people out there that didn't believe it. There's just people who weren't listening. So again, there's an extreme reason, not only misappropriation. I'm not worried about, I don't think if you ask me about this account, whether I worry about as much about misappropriation in the investment area, because again, to some degree it's hard to do. Usually the investments are held by a broker. So I'm not saying it's impossible, but I don't think I've seen that. I'm much more worried, as Carlos said, I think the biggest issue in this area is a valuation issue. But again, you're going to do the same thing. You're going to test all the controls. You're going to walk through transactions for proper approvals, purchases and sales, who's making decisions. Do the documents back that up? Or do the investment committee get involved in it? I know, again, the investment committees, we always have minutes. Every time there's a decision made where the broker suggests something, minutes are drafted up, emails go out. Everything is documented, why we did what we did, in the case there's ever an issue. And the auditors get to see this stuff. Again, we're going to see monthly reports. You want to see that, they're looking at things, and that the revenues are proper. What are the audit procedures? Again, you're going to do analysis. You're going to reconcile them to the general ledger, same as in cash. You're going to confirm securities and derivatives instruments. Again, confirmations, you're going to go to the broker, send them a confirmation of securities held. It's the same thing as you're going to do with cash. You're going through selected purchases and sales, seeing that they tie into the books and records. And then you're going to go back to the investment committee minutes. You're also going to look at the investment committee. What else are you going to do? Like I said, analytical procedures, obviously computations of revenue. You're going to see the listen, about my stocks that are paying dividends, and I get the revenue, and I get what I was supposed to. The books reflect that. We're going to look at the method of accounting for investments, valuation. We're going to be real careful around, again, the different types of securities, trading securities, held to maturity. What's the other one that asks itself? What's the one that you hold more than a year? Available for sale, thank you. going to go into it in detail because we just will spin wheels, but we're going to, the requirements on derivatives and hedging is an extremely, everybody understands what hedging is for the most part. This is where you're trying to minimize your downside risk on things by doing things to avoid, you're afraid prices of, you're in a business that needs precious metals. So you buy precious metals contracts in the future based upon prices today to guarantee yourself in effect, that you've locked in your price. If the prices go down, you'll be able to buy the metals cheaper, but your contract won't be worth as much. But you sort of locked in a price that you're willing to do, okay? But you get into all kinds of valuation issues and accounting issues. What you've got to be sure is that your client is capable of making these calculations, and if not, if you're purely on a public company, that they hire valuation experts or accounting experts to help them with this. This is something where you get another accounting firm. Normally, your accounting firm can't do it for you, and you don't know how to do this because, again, with a public company, you're purely an auditor. But if you do a lot of this stuff, you better have somebody at least understand who understands the accounting for a lot of this stuff and how to do fair value accounting. Carlos hit on that. Possible misstatements, recorded value. Normally, unauthorized investment transactions, sure it's possible. Do you see a lot of that? I don't think so. Incomplete recording of investments, well, possible. Like I said, I try to bring to you sometimes what I see in the world. I don't see a lot of that. Inadequate disclosure of the nature of investment activities. Yeah, there's one you got to be careful of. Making sure the disclosures are proper. Making sure in your investment that you've got them in the right levels. Tier 1, Tier 2, Tier 3. Are investments pledged as collateral against something? Is there more information about the nature of the investments that's required that's not being disclosed? So making sure that disclosures is certainly something as part of your audit you need to do. This is going through, again, substantive procedures.